Okay, here we are with Antonio on the Defiant podcast. Welcome and thanks so much for joining me today.
Yeah, thanks so much for having me.
Of course. So Antonio is the founder and CEO of dYdX, one of the biggest decentralized exchanges on Ethereum. It focuses on derivatives, and it recently made news by moving to, or being one of the first major DeFi projects to move to layer 2. So obviously, I'll be super excited to talk to you about all this. But first, as always, I want to know more about yourself, your background, and how you first got into crypto.
Yeah, absolutely. So I got into crypto back in 2015 when I had my first job out of college, which was at Coinbase as a software engineer. And I kind of got to Coinbase pretty differently than the way most people got there. The way most people got to Coinbase, especially back in 2015, is that they were really into Bitcoin, especially back then in 2015. Bitcoin was really all there was in terms of the interesting stuff going on in crypto. But I didn't really know that much about it. And kind of through the interview process, met a lot of really awesome people. Was really fortunate while I was there to be able to work with just a lot of the top people in blockchain at the time were at Coinbase. Or if they weren't, like they were probably coming to Coinbase and giving talks. Like, for example, like Vitalik came really early on in the life cycle of Ethereum to talk to us. And, Olaf Carlson-Wee was there giving presentations on smart contracts and gas usage on Ethereum and all this kind of stuff. So that just got me really excited about what was possible to build based on that new technology. And I wasn't exactly sure what I wanted to build at that point on Ethereum, but I was pretty convinced that there would be something to build on top of smart contracts that would be really big. So I really just see smart contracts as just kind of this new computing paradigm where for the first time you can write these programs, they execute totally autonomously, totally deterministically, obviously not controlled by anybody. And that's just really fundamentally different than what you can do in any other area of computing. And kind of every time you see like some new like step in terms of something new you can do in computing, there basically always is interesting stuff to be built on top of it. So anyways, that was back in kind of 2016, eventually left Coinbase in 2016. And after a few months, started my own thing. And kind of the first thing I started actually wasn't dYdX. It was something else. It was a search engine for decentralized apps. And this was back in 2017. So I built this whole thing out, was working on it for a couple of months and literally nobody used it. I think I had like 10 users literally ever. And the main learning that I took away from that was, in addition to building something that's useful, the timing of when you build it is really important. Like probably someday there will be a search engine for decentralized apps, but it certainly wasn't back in 2017 when there were only like less than 100 decentralized apps total. And there's like, what is the point of a search engine if there's nothing to search for? So after I spent a few months on that, kind of took a step back and was thinking about, well, okay, if this isn't working out, what's something else on top of Ethereum that I could build that's interesting? And that was right around the time when the very first decentralized exchanges were starting to come out. So things like Kyber and 0x were just starting to come out. Took a look at this, kind of, spent a little bit of time wrapping my mind around it and got pretty excited about it. And I thought that kind of the next logical thing to build after just base level spot, which just means like a fancy word for like buying and selling decentralized exchanges, would be kind of more advanced financial products like margin trading and derivatives. Because I really think of just finance as a stack, especially like decentralized finance as a stack, where like first you have decentralized money like Bitcoin and Ethereum and stuff. Then you have decentralized spot exchanges, like at the time it was like Kyber and 0x. And then the next logical thing to build on top of that is derivatives. But you like can't build anything higher in the stack without things lower in the stack. And that's kind of what I was getting at back with the timing points. So been working on dYdX since then. We were founded in 2017. So I've been around for a while now. And yeah, I guess kind of the rest is history.
Really interesting history. So I guess like you didn't really have like financial background when you started this project. And so it's interesting that you came at this like very just technically like finance like purely financial product from a technical perspective. Was it just because like finance is kind of the low hanging fruit on Ethereum, like what it just like makes sense to build on the network?
Yeah. I mean, I think this thought certainly extends beyond dYdX to kind of all of DeFi. But I think the area that kind of trust minimized computing can be the most effective in is finance, because finance is just like so important. Like trust is so important in finance. And like in the traditional financial industry, it's just really run through mostly centralized intermediaries. So that's kind of like very ripe for disruption if for the first time you can start building these financial building blocks that aren't controlled by anybody. And really see kind of the internet, like back in the day, is kind of like the decentralization of information. But the blockchain is really the decentralization of value, and value is kind of like a fancy word for money. So I think that's kind of the fundamental reason why it makes sense to focus on financial products as certainly the first use case for decentralized applications.
Totally. So can you explain a bit more about how dYdX actually works? Like we've seen this model of liquidity pools with automated market makers take off with Uniswap, and then there's this just more traditional model for exchanges, which is order book based. But it's harder to make that model decentralized. So can you get into like the backstage of dYdX? I mean, like first, like is it still non-custodial, and what kind of framework do you use to match trades?
Yeah. Good question. And that's a good backdrop as well. So we at dYdX are what's known as a hybrid exchange. So that means that we have some centralized components, which are our order book and our matching engine services, and then some decentralized components, which are, of course, the smart contracts, which run on the blockchain and make everything non-custodial. So given that we run on an order book, we don't run on automated market makers. And kind of the reason for that is just order books are a lot more efficient in terms of being able to make the exchange have much more liquidity for the same amount of maker capital. Like automated market makers are great, but they're very capital intensive. So you have to have, like, if you're Uniswap or SushiSwap or whatever, just like billions of dollars locked on the exchange to approach a similar level of liquidity as other exchanges that operate on order books have. So that's the way it works right now. And then I think the other piece that's really critical to dYdX, and the main kind of differentiator for us over most other decentralized exchanges, is that we're focused on more advanced financial products. So the current product that we're really focused on is a synthetic, which is known as a perpetual contract. Probably a lot of people in crypto are already familiar with this. It's basically financially the same product that was really popularized by BitMEX and is now super popular across the space on exchanges like Binance and FTX. But it's currently quite literally the most popular product in all of crypto by volume. Just in the past year, the volume of perpetuals has surpassed literally all the volumes for all the other products, including spot trading on crypto combined. And it's just looking like it'll continue to grow from here. So that's kind of what got us really excited about offering these types of products, is kind of the potential addressable market. The reason they're so popular is because they can be traded with leverage, which basically just means you can multiply your gains and your losses when you're trading and trade as if you had more capital. So it's a much more capital efficient way to trade. So that's kind of the main reason that they're popular on dYdX. Of course, they're totally non-custodial, completely transparent. And those are the main reasons, I think, why some users are choosing to trade on dYdX over other platforms that offer perpetuals.
Right. And I guess I think perpetuals just was a very kind of killer product in crypto because it just like very much simplified going long on different assets. I mean, this kind of futures contract that doesn't really ever need to get paid, so you don't need to kind of deal with that sort of like trading logistics, and you can just like hold it and go leverage long on something. But so while this is hugely popular on centralized exchanges, and BitMEX is kind of like the biggest exchange by volume because it's kind of the place that people go to trade these perpetuals. You're still, I mean, while among kind of the biggest exchanges or like DEXs by volume, you're still lagging like spot exchanges like Uniswap or like SushiSwap. Why do you think that is in DeFi, that like spot trading is more popular than derivatives trading?
I think it just has to do with kind of the maturation process of markets. And the DeFi markets are fairly separate from the CeFi markets. I think the same thing is starting to happen in DeFi that we saw in CeFi. Like in CeFi, back in the day when I was at Coinbase in 2015, Coinbase was more or less kind of the top exchange in the world. But one interesting thing that happened to Coinbase in 2016 is that Bitfinex pretty rapidly became the most popular exchange in the world by volume. And the reason that is because Bitfinex offered margin trading, and people wanted to trade. They wanted to trade on leverage, and we're using Bitfinex to get margin to do that. And then, we saw just this past year, actually. So it's actually a really recent phenomenon in crypto that, like I said, the derivatives volume with like BitMEX, Binance, FTX and friends, all just launching perpetuals and those becoming super popular within the past year. So I think it's something that takes time. Just fundamentally, like perpetuals are more complicated, both to build, to use, like all of this than spot trading is. So both for us, like it's, this is kind of a bit of a generalization, but it's like technically harder to build like dYdX than it is to build like a Uniswap or something like that. Just because like these contracts that we're offering are fundamentally more complicated. Like you've got to deal with liquidations, you've got to deal with like Oracle prices, like all the stuff. And that's what we've been working on for the past 3.5 years, but it does take time. We're only just now about to launch our layer 2 product, which we think is like a really big step up for trading perpetuals. So I think it's just a time thing. Like in every market ever, basically, it's like, it starts with like the asset, then you like start with spot trading, and then you start like trading more advanced financial products on it. So it just doesn't really seem super likely to me that that's not going to be the case in DeFi. I think it just takes time.
Makes sense. And so like this maturation, like for that to happen, what do you think is missing? Is it like a matter of right now DeFi is mostly being led by retail traders, and then institutionals will come in and they will want these more complex products? Or so is it like something that has to do with the user, or also like the product itself? Like maybe there are features on dYdX that are missing to make this, to make dYdX like beat the spot trading.
Yeah, I definitely think it does start with the user. In terms of, obviously, derivatives are more complex a problem, like I just said, than spot trading is. But also, like the types of traders that trade derivatives are much more like professional. They're not all like hedge funds or crypto hedge funds and things like that. Certainly, there are individuals that do it as well. But kind of like the product experience and kind of the level of professionalism of the product and, number of features like reliability, all this kind of stuff. For derivative products is actually like much more important to the users than just spot trading is. So I think for that reason, we have to like, if you want to make like a product for perpetuals or for advanced financial products, it has to be really professional. It has to be really performant. It has to have lots of features. And again, that just takes like more time to build than like a very simple interface like Uniswap. That's just like buying and selling a token. And that's not a knock on Uniswap like at all. That's like they have found amazing product market fit for like their target users, which are for the most part, like, and this is a generalization, but for the most part, it's just like users who want to trade DeFi tokens and are like relatively simple. But again, in terms of like allowing the DeFi space to level up in terms of the sophistication of traders, it just takes a little bit more time to make like these more complex products that they need.
And speaking of users, can you dive a little bit deeper on what users you're seeing on dYdX? Like, are they, where are they from? Are they hedge funds? Are they like retail traders?
Yeah, so I think most of them are still retail or like individual traders. Certainly there are some crypto hedge funds that trade, and they're actually very important for the most part. Those are our market makers. We've, I think, done a pretty good job kind of behind the scenes for our layer 2 product launch in terms of just getting a lot more market makers and programmatic traders trading on the exchange, which is really important for liquidity and also volumes. But in crypto, it's really like, it's kind of different than traditional finance in crypto. In crypto, like the funds really follow the individual traders, not the other way around. Whereas like in traditional finance, it's like the retail traders just kind of follow the funds or just trade directly with the funds on like a Robinhood or things like that. So the name of the game, if you're an exchange in crypto, is just like, making the best possible product for individual traders. And again, for us, that doesn't mean like we want to like market to somebody who literally just bought their first Bitcoin. We want to market towards like the more sophisticated individual traders, like I was kind of talking about. And that's kind of what we're focused on right now. Yeah.
And in terms of geographies, like where do you know where they are based?
Yeah, I mean, for the most part, it's international. Derivatives trading is really big in Asia. One of the big things we've been focusing on the growth side is just expanding in Asia in a really big way. Like we just recently hired our first employee in China, and they're kind of bringing other people on board in other markets. So that's the main market we're focused on. But it's really global, actually. It's like pretty distributed, like a lot of different countries in Europe. Some countries in like South America, like India, like Russia, to kind of a lesser extent, things like that. But it's pretty global.
Cool. And because there is no U.S. Trading, right? Or like U.S. traders are locked from the site?
Yeah, that's correct.
Okay. And that's for like all products, or is there like some part of like dYdX that's open for the US?
Yeah, it's for our perpetual product. So all of layer 2, basically, and kind of the new product there is not available to US customers. But margin trading, borrowing, and lending, which are currently still operating on layer 1, are still available to US customers.
Okay, got it. And I mean, I guess that's kind of like a regulatory based decision, right?
Yeah.
Yeah. Okay. And then going to the layer 2 announcement, why go to or I guess like let's start with like what is this move going to mean for dYdX? Like how is the experience going to change for users?
Yeah, in a couple really important ways, I think. It's a little hard to like overstate kind of the importance of this product launch for us. I mean, the first is pretty obvious, just the fees will go way down because users will no longer have to pay Ethereum gas fees. If you've ever used an Ethereum wallet or DeFi product, especially recently, you're probably used to paying pretty exorbitant fees, and dYdX layer 1 was no exception to that, where it was oftentimes costing us like 100, literally up to like $1,000 sometimes to execute a single trade. And it's just really hard from a business perspective. Like who's going to use an exchange where you have to pay hundreds of dollars in fees per trade? Like probably not that many people. So that's the biggest advantage is now our fees, because the scalability is like, roughly 1,000 times better or so. So our fees will be much more in line with what users are used to on just more centralized exchanges and things like that. But it doesn't stop there. There's a couple other like really important product benefits. And I guess the other thing I want to stress is like the product that we built for layer 2, it's not just like we took the layer 1 product and like put it on layer 2. We built an entirely new product from the ground up. It's still operating on perpetuals, which we also had on layer 1, but it's pretty significantly different product. So the second big advantage is cross margining, which kind of sounds like a fancy financial concept, but it's not that complicated, actually. Basically, what it means is that now you can use on dYdX just one account or one pool of collateral to collateralize any different position you might want to trade on together. So say you wanted to trade like Bitcoin and ETH, you just like deposit your however much into dYdX and then immediately start trading all the assets you want to. Whereas on layer 1, due to the scalability and some other concerns, we were only able to offer isolated margin. So for example, in the same thing, you want to trade like Bitcoin and ETH on dYdX layer 1 perpetuals, you would have had to like deposit separately to like every different market that you wanted to trade on. And that was especially capital inefficient for market makers. Like imagine if you're a market maker on dYdX and there's only isolated margin and dYdX has like 50 markets, you have to put down collateral like 50 times to be able to market make on every market. And that was the main thing that was holding us back from launching a lot of new markets on dYdX. So we're really quickly going to be launching, roughly like 15 to 20 new markets after our public launch of the layer 2 product. And it's really just driven by this cross margining. Some other advantages are just kind of the speed and the performance of the user interface. So now when you make a trade on dYdX, it executes immediately, like as fast as centralized exchange does. Like no longer do you have to like make a trade and then wait for your transaction to get mined and like see that, dreaded spinner on the website for like a few minutes while your transaction is sitting in the mempool. And then the final improvement is also pretty important actually, and that's just a really big step up in terms of the performance of our price oracles. And basically what we did, I think it's pretty cool actually. We basically took the exact same price oracles, which are reporting on layer 1 Ethereum, like the top ones. So we're partnering with Chainlink and also MakerDAO to be able to do this. And we took the same prices, like the same security, same everything, but we're putting them on layer 2 instead. And the cool thing about that is now instead of just like reporting a price every 15 minutes or so, we can report a price like roughly every few seconds. And this is really important actually for being able to unlock higher leverage for us in a safe way. Because the thing that was holding us back on layer 1 to offering higher leverage is the lag for price oracles. So a lot of times it would take like 5, 10, sometimes 15 minutes for a price change to be reflected on layer 1 Ethereum, just due to like transaction costs and things like that. And that's kind of scary if you're a leveraged exchange, because the thing that you have to think about then is like, what's kind of the maximum price drop of the assets that you're supporting before like the price oracle actually updates and you can liquidate people. And that used to be like, 10 minutes. And now we've gotten it down to like seconds, like single digit seconds on our new product. And that's what really unlocks just us being able to offer higher leverage safely. So starting with 25x leverage on kind of the BTC and ETH markets for the new product. And that's really important as well for our users. Binance put out this kind of like pretty interesting data about their users' usage of leverage on Binance futures. And kind of the average is around like 20x or so. So we're well able to support that with the kind of the 25x leverage that we have. There's certainly always going to be some I think it's like roughly like 5% of users or so, like will use the like 100x leverages of the world. And we're not quite there yet. But I think we're able to support 90% of the leverages like users will actually want to use.
Yeah. So, I mean, tons of improvement from cost to speed to just capital efficiency with having the ability to have like one asset for like different margins, and like the oracles. So that's great. And then I'm still kind of like I really haven't tried layer 2. So that's kind of disclosure there on like how it actually works. Like, will users have to create a separate account now to use this new kind of dYdX product, or will it work with their old like with the same kind of Ethereum account? Is it like a separate wallet on StarkWare? How like practically, like how does it work?
Yeah, that's a great question. And this is actually one of the really cool things and one of the reasons why we chose StarkWare. It's basically a rollup that settles on the layer 1 Ethereum chain. And that just means that users can continue to use their current like Ethereum wallets, their current Ethereum addresses and everything like that. So there is basically a sign up step. There's like one transaction you have to send basically to a smart contract. That's basically like creating your account on layer 2. But that's it basically. Like after you've sent that one time, like that one transaction, then you can just start depositing like you would to any normal exchange and start trading immediately. So it's a pretty seamless user experience, we think, and something that I think is really unlocked by just building on a rollup that settles on Ethereum.
And is this transaction, like how much does it cost? Is it like a regular Ethereum transaction?
Yeah, it's like a regular Ethereum transaction, basically. I don't know if this means anything, but it costs like roughly like 100,000 gas or so, 150,000 gas, which is kind of in the ballpark of like a Uniswap trade or something like that.
Right. Okay, so I guess like this would be like kind of the bigger upfront cost, and then like trading on dYdX itself wouldn't, like that would just be cents, I guess.
Exactly. Yeah.
Okay. Okay, and then on like why StarkWare and zk-rollup itself? I mean, there are tons of different, or not tons, but at least a few different layer 2 solutions. So why this specific one?
Yeah, absolutely. So the three main things we considered were obviously zero knowledge rollups with StarkWare, considered optimistic rollups, and kind of optimism is the leader there. And then also considered other layer 1 chains. In terms of like why not other layer 1 chains, it kind of has to do a lot with what I was just talking about. We wanted something that was compatible with Ethereum and compatible with our users' Ethereum wallets. And that's just like critically important. And a lot of these other chains, they're not quite there yet in terms of being able to offer like really great wallet experiences or CrossChain and things like that. So for that reason, we decided not to use a different layer 1. In terms of why ZK rollups over optimistic rollups, so it's for a couple different reasons. First of all, we think the security and kind of decentralization of zero knowledge rollups is better than optimistic rollups. Zero knowledge rollups, basically they use cryptography, just like this new concept called zero knowledge proofs. And high level, the way that they work is you can take an arbitrary amount of data. So in our case, say that's like all the trades for the past hour or whatever on dYdX. And then you can run a zero knowledge proof or a Stark-based proof on them and kind of transform them down into this constant size data object. And the cool thing about it is no matter how many trades you have in the batch, the data object is always the same size. And that's what's known as the proof. So you just like put this proof on the chain, and then immediately the contract knows how to validate the cryptography around the proof, basically. And it's quite literally like cryptographically impossible for an invalid state to be submitted to the chain because of the zero knowledge stuff. So that's really cool, because one of the things about optimistic rollups is they just rely on game theory to basically be able to secure the chain. And that just means they have to have like a really long challenge period. So very high level way like optimistic rollups work is like the operator can submit any state to the blockchain, like even if it's invalid. And then they kind of rely on like other people watching the chain and just being like, and then there's like a way after that, if they submit an invalid state to be like, no, like, aha, like here, I'm going to present to the smart contract, the operator like made this invalid state. So we're going to like roll the state back. And that's the way like optimistic rollups work. So it just relies on like incentives rather than cryptography, which, you know, we think we like to just continue to rely on cryptographic like primitives as much as we can. And the other thing,
does that mean that like the withdrawal periods for optimistic rollups would take longer? Like if you need to wait for a challenge, I mean, does it make it just like slower to trade?
Exactly. That's actually the thing I was literally about to mention, but good thought on that. Yeah. And that's actually a really big piece of it, because you have this challenge period, like you just said, on optimistic rollups, there are really long withdrawal times where nobody can withdraw. And usually these withdrawal periods are roughly a week or so. So that was a problem for us because, you know, who's going to use an exchange where you have to wait like a week to withdraw? It's obviously a pretty big product limitation. There are ways you can get around it. And the main way people are thinking about getting around it, both for zero knowledge rollups actually and optimistic rollups, is using what's called like a liquidity provider that can basically like front the withdrawals and can immediately like pay you out. But the issue with that, with optimistic rollups, is the withdrawal period is still pretty important, because you need, suppose you're this liquidity provider, you need capital proportional to like all the withdrawals that everybody wanted to do on dYdX for the entire week. You'd have to have like that much capital. And for an exchange, that's just like so much money, because like people are like moving in their funds like in and out like all the time. It'd be like millions and millions and millions of dollars. Where we or like any of our partners like don't actually have that much money to like take on this liquidity provider role. We're actually doing this, basically what I just said, for zero knowledge rollups. So you actually don't even have to wait on the new dYdX for a batch to be submitted, which happens like roughly like once an hour. A batch just means like that process of doing the zero knowledge proof and like putting it on chain. That'll happen like once every hour, but you don't even have to wait for that for withdrawals, because we're doing that thing where we operate the liquidity provider. But the cool thing about that is now the liquidity provider only needs capital proportional to an hour of withdrawals on dYdX. And that's much more tenable, right? That's probably like, you know, roughly like $1 million or so. And with reasonable fees, you can allocate that effectively. So yeah, those are all the main considerations.
And so in that case, are you like, is dYdX a liquidity provider or is kind of a third party?
Yeah, we're starting out doing it ourselves with our own capital, but we definitely hope to open it up to other partners really soon as well.
Okay, got it. The other piece with layer twos is like how well they can process smart contracts, or if they even can, right? Like I think that's kind of the other big consideration. So obviously, if you're doing this on the StarkWare with zk-rollups, that's kind of a solution that does support smart contracts, right? I mean, what solutions out there have like this like limitation?
Yeah, it's a great question. And I think one of the big selling points of optimistic rollups is that they're Solidity compatible. So, theoretically, you can just take a smart contract that was running on layer one and maybe with a small amount of modifications, get that up and running on an Optimism really simply. It's not that easy on zero knowledge land right now. So basically right now for our new smart contracts, StarkWare, and this is the reason we're partnering with them, but they basically built like all of the zero knowledge stuff about our new protocol for us. So that's what we've been working with them on for the past 6 months or so. So it is possible, and you can build pretty complex stuff like, perpetuals and dYdX even on layer one, or some of the more complex smart contracts that are on the chain. And already we're able to move them to layer two. One of the things StarkWare is working on right now, which is, I think, just recently launched, is they basically launched their own programming language called Cairo, which allows just any developer to write their own program that like runs on zero knowledge proofs or Stark proofs for the most part. We didn't write our own. We didn't use that for our stuff because they just recently came out with that. But we probably use that if we were to build other things on top of StarkWare.
Oh, that's interesting. Okay, so that's kind of an interesting set of trade-offs between the different layer twos. So with Optimism, it's easier to build smart contracts and maybe just develop complex applications there. But the withdrawal times are longer, and you don't have like cryptographic security. But then with something like zk-rollups, it's harder to build like smart contract based applications, but you have like the other benefits that you mentioned. So I think like with like all the scaling issues that Ethereum is having now, and it costs like hundreds of dollars to do sometimes like a single transaction, and it's like becoming unusable for many individuals. It's like the question is always like, why isn't everyone just like going in mass to layer two? But obviously, you kind of give a glimpse at that. Like, it's just like hard to build on these networks. But I'd love to hear more about it, like, because I think everyone's kind of asking that question, like, when is everyone going to go to layer two, and like all these gas fees will come down for us?
Yeah, it's a really great question. And hopefully we can, at dYdX, help be like a trailblazer in terms of like motivating people to move to layer two. Like I said, I think the product is just like so much better. It's even beyond just like not having to pay $100 gas fees anymore, to the point where people won't want to use products that are on layer one if there are like similar products that are available on layer two. And that's obviously a really big motivator to like get developers to build things on layer two. But in terms of like why hasn't happened en masse yet, I think it's a combination of things. I think, first of all, just a lot of these scaling solutions are pretty nascent, or like they haven't really been tested in production yet. That was one of the things that drew us to StarkWare, actually, is that they have a history already of running in production. So they're running as of like, a year ago almost, I think, with another decentralized exchange called Diversify, which has been running on StarkWare without basically any issues. So that gave us a lot of confidence that it would be production ready. Things like Optimism are super exciting, and I'm also excited about it, are not quite production ready yet. I think as far as I know, like Optimism is like running on mainnet right now, but has some limitations around that mainnet. Let's definitely keep an eye on like kind of what happens when they open that up. In terms of like other layer one chains, yeah, a lot of them are on mainnet. That's just happened recently. Like I said, a lot of the developer tools, a lot of the wallet infrastructure, stuff like that isn't quite there yet. So there's a ways to go on that. So I think that's mostly it. And then I think the other thing people worry about sometimes, which is a super valid worry with layer 2, is kind of the loss of composability on layer 1 with Ethereum. I think it would be interesting to see how this plays out, because it seems like a lot of different projects are moving to like different layer 2s. Like, we're moving to StarkWare, like Synthetics is moving to like Optimism, like I think like Curve or something is like moving to like Near, or like, the list goes on. And I think that's definitely a real concern. One of the reasons I think you see some of the like synthetic protocols, like us and Synthetics, being real trailblazers in terms of moving to layer 2, is that, at least in my opinion, interoperability is a little bit less important for synthetic protocols, because you don't need as many like things to exist on layer 1. Like, for example, like suppose like Uniswap were to move to a layer 2 as an example. You need, as Uniswap, like all of the tokens that your users want to trade to also be on that layer 2, right? Like who's going to use, like who cares if Uniswap is like on layer 2 if like none of the tokens you want to trade are on layer 2? Whereas for us, because it's synthetic, like we don't actually need like tokens to be on these layer 2s. We can basically just have only one collateral token, which in our case is USDC, be on that layer 2. And then we can just create like a synthetic contract for any asset based off of that. And then the other thing I'd say on that point is like we at dYdX kind of take a really full stack approach to building products. So we build everything from the smart contracts to the back end that runs our matching engine, to the front end, to eventually the mobile apps. So we really just think like by building like everything like vertically integrated, we can build a better product than what would otherwise be possible if it's like a lot of different teams kind of working on the same thing with different levels of the stack.
That's so interesting. I hadn't really thought about why kind of the first two projects were synthetic or like derivatives projects. And yeah, it really does make sense. So with your move to zk-rollups based layer 2, are you betting that most other DeFi projects will move there? Because I mean, like you said, it's about composability, right? Like that's like the important piece for layer 2 scaling to work, for like DeFi to maintain these kind of money Legos snapping together.
Yeah, I wouldn't say we're counting on it. It would certainly be good. Like the more things that are on like the same layer 2 that we're using. But I think it just goes back to the point I was just making in terms of like, we try to take a full stack approach, try to build as much things in-house as we can, basically, and not have to rely on like external people. That said, like we do rely on like some external integrations that actively make our product like a lot better. For example, like one of the things we're doing on our current layer 2 product right now is an integration with the 0x API, which is basically 0x's like DEX aggregator that they have, to allow users to deposit any asset and have that like automatically converted to the USDC that's held as collateral in our contracts, but make like a really seamless deposit experience. So like you go to dYdX, you could like deposit ETH, automatically gets converted into USDC under the hood through 0x API. And that's all possible because of the composability there. So I think it's definitely important, but all is not lost without it. Like I think a lot of the advantages of just like so much more scalability and the other stuff I was talking about before kind of far outweigh some loss of composability for us, especially in the short term.
Okay, so wait, I guess I missed the part about the 0x API. Like, will you be able to add that to layer 2 or no?
Yes, So it's on layer 1 actually is how that works. So basically like when you're depositing funds to layer 2, like they're still on layer 1 on Ethereum, right? Okay. So we basically built like what's called like a proxy contract, which is like a contract that sits in front of like the smart contract of the like StarkWare smart contract that will basically like take your funds, call 0x API, like convert them on layer 1 Ethereum into USDC, and then like deposit that to layer 2. So it's still the same thing as like all of that interaction doesn't actually happen on layer 2, and like you have to pay gas for it and stuff like that. But we definitely think it's still a pretty good usability improvement for our users, because a lot of people will come with like USDT or something or like ETH, and they, we want to make it easy for them to use the product as well.
So that's interesting. So, okay, so that means that for projects building on layer 2, they can still use parts of their like features and functionality run and have them run on layer 1 if if they require other projects to do that. So you can kind of like move to layer 2 without needing kind of the entire Ethereum ecosystem to be there to maintain kind of that same functionality.
I think for the most part, that's true. Like you can basically use like the stuff on layer 1 Ethereum, especially when you're doing deposits to the system or withdrawals from the system, right? Because like one of those is kind of touches both like Ethereum and like StarkWare in our case. So you can definitely use them in those cases.
Oh, that's interesting. And I wanted to talk to you about this like CrossChain DeFi world, because you mentioned like briefly that you had considered going to other chains, but you decided that to you was important to just stay on Ethereum because of the infrastructure. Still, like, do you plan on moving to other chains when there is more infrastructure built and when you see there's kind of more community there, or do you first like plan to just focus on Ethereum for the like time being?
Yeah, it's a good question. I guess the answer is like we're not sure yet. Probably not like in the immediate future we would migrate to anything else. One of the cool things about layer 2 and especially StarkWare system is that it actually doesn't really matter like what the base chain is. Like fundamentally, like with a few changes, like the stuff we're building on StarkWare could say run on like Near or Solana or something like that as the settlement chain. And then you got to get the power of like, you know, Solana times like the power of StarkWare, which is like even potentially more, as an example. So we could definitely do that at some point if we needed to, but I think it's probably not necessary yet.
Right. And then I wanted to ask you about these other synthetic asset platforms like Mirror that kind of like grew really quickly recently because they added like US stocks token derivatives on the back of like the whole Wall Street Bets thing and like Robinhood drama. Is that something that you plan on doing, adding these like traditional asset derivatives on dYdX?
Yeah, I'd say we're definitely interested in it, or definitely considering it for some time in the future. But I think just like I've actually kind of been surprised by this, honestly, but I think just like in crypto, like a lot of people have tried this over the years, basically just like putting like real stocks on like crypto exchanges. Yeah, I think Mirror is a good example of that. Maybe a more like mainstream example of that is the cool work FTX is doing with like listing like tokenized versions of stocks and things like that. But if you look at the volume on those, they're never really that high compared with like the volume on like Bitcoin or Ethereum or things like that. And I think that the reason for that, and especially if you're a decentralized exchange and, you know, as a decentralized exchange, basically all of our users are like super crypto fluent, like super crypto native, right? Like still like we want to improve on this, but still it's like, you know, you got to know how to like download MetaMask or like whatever, or like IM token and like back up your private keys and all this stuff. If you know how to do that, you probably like understand crypto and you probably like want to trade like Bitcoin and ETH, like more than you want to trade like Apple or something like that. And so I think for the most part, I guess that's my hypothesis on like why they haven't taken off yet. Because even for like centralized crypto exchanges, like even if you're like an FTX or a Binance or something like that, it's a more challenging user experience to like get into that, get into like the crypto ecosystem than it is to like start using like Robinhood or something. So yeah, definitely keep an eye on it, I guess, is the TLDR. But yeah, we kind of want to see some more volumes hitting some more other exchanges that offer like these types of products before we get there.
Yeah, no, that's an interesting distinction. It's like people who are already trading on DEXs, they probably just want to trade crypto and not traditional stocks anyways. Okay, and then I want to just talk about DeFi more broadly, like your thoughts on this space, like the incredible growth it's seen so far. Like, how has it surprised you, like how like TVL went from $1 billion early last year to over 40 billion today, ETH going to 2000. Like, I don't know, this like crazy explosion in crypto and DeFi. Do you see kind of this speed of growth continuing? And what is kind of the long-term vision for dYdX in the context of DeFi? Like, do you see DeFi just like overtaking traditional finance and dYdX kind of like leading the charge there, or do you see it as something that will like continue running in parallel to Wall Street?
Yeah, definitely. So I guess first of all, in terms of like the level of growth we've seen in DeFi and just more broadly like the crypto space, I mean, it certainly surprised me. I would imagine it surprised like pretty much everybody. And really the catalyst, I think, especially for DeFi, was Compound launching Comp, which seemed like a little bit of like an innocuous thing. Like if you remember where we were like back in last summer, and that was still kind of in the crypto winter, and like Compound was like launching their token. And kind of the thing that they invented, which was really awesome, is like liquidity mining. And I mean, they weren't the first to do it. There are actually like some other centralized exchanges. There's one called like Fcoin and a few others, which did like something similar to liquidity mining. But it really caught on in DeFi, which I think was surprisingly exciting to a lot of people. And then kind of like fast forward to a lot of the adoption we started to see with Uniswap. I think just like Uniswap, like finding product market fit was like a really watershed moment for the DeFi space. Just in terms of the like, great products, like period, like whether it's centralized or decentralized, just go to this like really simple page, just like trade any token to like any token. Has way more tokens than all the centralized exchanges do. They're listed way faster. Like the liquidity is pretty good as well. And then a lot of the stuff they added on top with like the governance, I think was super cool as well. So lots of like really interesting stuff. I mean, I think it sometimes just happens like this, where it feels like almost out of the blue that like these things happen. Because, I guess for us and Compound and, to a certain extent, Uniswap as well, we've kind of been around for a couple of years now. And then sometimes it just like turns the corner and you turn on the jets for this space and everybody, starts using your products, which is awesome. So then kind of to answer your second question in terms of like, how do I see dYdX playing in terms of like DeFi, or like what are our goals like more broadly? Our goal is pretty big, I think. Our goal is to become one of the biggest crypto exchanges, period. But on kind of a 3 to 5 year time horizon. I think it's still going to take some time. Like, DeFi isn't going to be built in a day. Or even a year. And I think there's still a lot of work for us to do in terms of continuing to optimize like the user experience, continuing to like decentralize more parts of our stack that we're really going to focus on over the next year or two. And it just takes time for like two-sided marketplaces to like be built up in terms of like liquidity and stuff like that. But I think, obviously I'm biased on this, but I think we're in a pretty good spot. In the thick of derivatives, as I kind of touched on before. We think derivatives are pretty obviously going to be, and already are going to continue to be just like the biggest products like in crypto. So, if your goal is to become one of the biggest crypto exchanges, you basically by definition have to support like the biggest product in crypto. And we feel like we're doing that. And then obviously the other bet that we're making is that DeFi is going to be really big on that time horizon. And hopefully we can continue to help push forward a lot of the cool things that are going on in the space more broadly there too. DeFi is super exciting, but still remember it's like, 5% or whatever of the like volume that's like going through like all of the other exchanges, all of the other centralized exchanges in crypto. And I think, but again, that's like up from like 0%, like, 2 years ago when this stuff like literally wasn't invented. So I think a lot of people can see the writing on the wall, and that's why people are excited about it. And we're excited as well. But so lots of optimism for the future. I guess like the one caveat I will give is like, I feel like especially in crypto, in all new markets, but I think especially crypto, because there's like a price tag on everything that you can literally always see. A lot of the innovation or a lot of the hype seems to come in booms and then, consequently busts. Mm-hmm. So I would anticipate that that's certainly going to happen at some point in the future. I mean, it's not really rocket science. Like, look what's going on with like some of the valuations of like random tokens and things like that. And there'll probably be corrections and things like that. But the important thing is that like the teams in the space that have been here and have been building are going to continue to keep building. It's not like, the progress of like dYdX moving towards like full decentralization or like our next product or whatever is going to like significantly stall if there were a correction or something like that. And then like every time there's like a really big hype cycle, like people kind of wake up and are like, oh, wow, this stuff is really cool. Like, yeah, it's almost like you put like 2 years of effort into this, like for Uniswap or whatever. And it's like, yeah, we did. And like nobody was paying attention. So it's nice when like people are pretty hyped on it as well in a similar way. But also the periods where you can just like, heads down build are pretty nice too. And you just have to have faith that long term, the market's going to be there and you're going to be able to capitalize on that.
Yeah, well, I think like most of DeFi was built on a bear market. So I think, if there's another one, like no reason to think why development will stop then. So like last question, I mean, you mentioned that you want to progressively decentralize dYdX on like how do you plan to do that?
Yeah, good question. So honestly, we're still kind of in the architecture phases of this, or like still trying to figure it out. And that's one of the main things we're going to be focusing on, especially over the summer. For us, as I touched on before, the really big critical piece that we need to decentralize is kind of the order books and the order matching. And we run those in a centralized way right now for performance. And we'll continue to do that on our layer 2 product for now. So figuring out like different ways to potentially like, optimize or decentralize the order books. That'll be a really big project for us. Also decentralizing kind of like the control of our smart contracts. So we still operate under the like multi-sig module or like paradigm, where basically our contracts are upgradable by a multi-sig contract, which is delayed by like a contract enforced time lock. But it's not as decentralized, certainly, as kind of a different protocol that may have decentralized governance. So potentially like focusing on decentralized governance, like we've seen a lot of other protocols do, involving the community more in decision-making, things like that, are all things we have slotted for the rest of the year.
So that would imply a dYdX token.
Yeah, I mean, we're definitely thinking about it. Again, we haven't like announced anything around that or anything like that, but we think it would be value add, like if we were to do something like that in terms of like allowing like the community to get more involved in governance and things like that. I mean, it doesn't have to, like we saw compounds, like even before their comp token, they were doing a lot of interesting, like innovative stuff with governance. But I mean, we're not blind basically, like we see what's going on with all the liquidity mining and with all of the governance and exciting things with the community that are going on with other projects. For us, just really like our hypothesis around it is like, we're not like fundamentally anti-token or anything like that. We just really think that like the way you get really big is like, first of all, you like build an amazing product and you like find strong product market fit and you start growing like without a token. And then like once you do a token and are able to like throw the fuel on that fire, like once you have a product you believe in and that can scale and that you think like it's high quality and can grow, and then you, like I said, just throw the fuel on the fire. Like that's how we think like we'll become like really big.
I mean, pretty much what Compound and Uniswap did. They started without a token.
Yeah,
and
absolutely.
They've been successful with one. Okay, so that'd be really exciting and interesting development. We'll obviously be keeping track of that on the DeFi. So anyways, we're at the end of the hour. And it's been such an interesting conversation. Antonio, thank you so much for joining me.
Yeah, thanks so much for having me and the great questions. Really appreciate it.